All right, let's get into it. Today, we're going to crack the code on a super important financial tool, the cash flow statement. Now, I know what you're thinking, accounting jargon, but stick with me. This is all about finding out where a company's actual cash comes from and where it's going. And to show you why that's so important, let's kick things off with a bit of a puzzle.
So, let me ask you this. Can a company that's making a profit, the kind you read about in the news with soaring revenues, could that same company actually be on the verge of going bankrupt? It sounds completely backward, doesn't it?
Well, believe it or not, the answer is a big yes. And here's why. And it's a really crucial point. Profit isn't the same thing as cash. Profit is an idea on a spreadsheet. But cash? Well, cash is what you use to pay your employees and keep the lights on. A company can look great on paper, but have zero money in the bank. And that is exactly where our hero of the story comes in, the cash flow statement. Its whole job is to cut through all that accounting noise and show you what's really happening with the money. It's the ultimate truth teller, tracking every single dollar that actually comes in or goes out of the business. You see, an income statement is great, but it can be a little misleading. It might show a huge sale as profit, even if the customer hasn't paid yet. It's basically counting an IOU. But the cash flow statement, it doesn't care about promises. It only cares about real money that has actually hit the bank account or left it. So how do we read this thing? Well, the best way to think about it is like a detective novel broken down into 3 main chapters. Each chapter tells a crucial part of the company's cash story. Okay, part 1 of our investigation. This is the big one. We're looking at the core of the business. You could call it the engine room, the company's day-to-day operations. What this section really answers is the most important question of all. Is this company's main business actually making any money? Is the act of selling their products or services generating real cash? For any healthy business, the answer here has to be a big fat yes. Now, if you take a look here, you can see how it works. We start with net earnings. That's the profit we talked about from the income statement. But then we make a bunch of adjustments to strip away all the non-cash stuff and get to the real cash number. A lot of these adjustments have to do with something called working capital. It sounds a little technical, but the idea is simple. It's just the money that gets tied up in the everyday running of the business. It's the fuel that keeps that operational engine going. And working capital really just breaks down into 3 things. You've got receivables, which is money your customers still owe you. Then there's inventory, that's cash you've spent on products that are just sitting on a shelf. And finally, payables. Those are the bills you haven't paid yet. Juggling those 3 is absolutely key to managing cash. All right, we've figured out how much cash the business is making. Now for the second part of our investigation. What is the company doing with that cash? Are they putting it to work to grow? This brings us to investing activities. This section is all about the big moves, the major purchases. Is the company spending money on a new factory? Are they upgrading all their computers? Or maybe they sold off some property. Any of those big ticket items meant to build the company for the future, that's what you'll find here. And you can see a perfect example of this right here. Notice that $500,000 figure in parentheses? That means cash went out. In this case, the company spent $500,000 on new equipment. That's a classic investment in its future. So we know the cash they make, and we know the cash they invest. We're on to the final piece of the puzzle. Where does the company get cash from if it's not from its own operations? Well, that's the financing story. This part of the statement tracks money moving between the company and its 2 main sources of outside cash, lenders like banks, and owners, meaning shareholders. So things like taking out a new loan or paying a dividend to investors, it all shows up right here. And if we look at our example, you can see a positive $10,000 next to notes payable. All that means is the company borrowed 10 grand. That's cash in the door, a classic financing move. Okay, detective, we've gathered all the clues. We have the story from operations, from investing, and from financing. Now it's time to put it all together and give our final verdict on this company's financial health. And you know what? The math is actually beautifully simple. We just take the cash from operations, subtract the cash they spent on investing, and add the cash they brought in from financing. And that's it. Boom, there's our answer, the net cash flow. For this company, their cash went up by over $1.5 million during this period. Now that is what you call a healthy sign. So at the end of the day, what does this actually mean? A positive number tells you that the company finished the year with more cash in the bank than when it started. Plain and simple, they brought in more money than they sent out. And there you have it, the 3 parts of the story that reveal a company's financial truth. So the next time you're looking at a business, don't just ask if it's profitable. Now you can ask the much smarter question. What's the real story its cash is telling you?